You open your laptop to execute a high-conviction setup, but the page won't load. You've been blocked before you could even place the order. This is the daily reality for Indonesian retail traders. Internet Positive acts as a wall between your desk and the global markets. That wall exists because your need for global liquidity and 500-to-1 leverage often clashes with a protective local regulatory framework. It leaves you with a choice. Do you trade within the safety of local regulations, or do you navigate the technical workarounds to reach offshore brokers? This choice dictates the rules you trade by, from the legal protections you keep to the execution costs you will eventually pay. To navigate this, you have to understand the strict divide in how Indonesia regulates your money. Many traders look to the OJK for protection, but they strictly handle traditional finance, banks, insurance, and the stock market. The OJK does not regulate Forex. If a broker claims OJK approval for currency trading, they are either misinformed or intentionally misleading you. This flowchart shows the actual jurisdiction. For Forex and commodity futures, BAPEPT, also known as KAFTRA, is the sole legal authority. Trading with an offshore broker isn't illegal for you as an individual, but it places you outside the safety net. If an offshore broker defaults, BAPEPT has no legal power to help you recover your funds. Distinguishing between these jurisdictions is the first step in avoiding local scams and offshore traps. The first path is the strictly local route, keeping your capital with brokers who hold an active BAPEPT license. This offers absolute legal protection and simplified funding through direct transfers from local banks like BCA, Mandiri, or BRI. This chart plots local brokers high on safety but low on leverage. BAPEPT mandates a 1-to-100 leverage cap, limiting smaller accounts. You also pay higher costs. Smaller local liquidity pools result in wider spreads, around 2 pips, compared to near zero spreads globally. Choosing the BAPEPT route guarantees security, but it functions like a constraint on traders who need low overhead and high margin availability. The alternative is the offshore route, using global brokers that utilize ECN execution models. Updating our chart, the offshore node plots opposite, high leverage and tight spreads, but low local safety. Consider margin for a one-lot position. Locally, you need $1,100. Offshore, that same trade only requires $220. However, taking this route means accepting total personal responsibility for your capital. If the offshore entity disappears, you have no local recourse. The offshore route provides the mathematical power required for active strategies, but it requires you to operate without a safety net. For many, the choice isn't just about math, it's about values. The DSN MUI fatwa states that Forex is permissible only if it avoids interest, uncertainty, and gambling. To meet these standards, you must eliminate overnight interest, which requires a dedicated swap-free account. Be careful with offshore labels. Many brokers claim to offer Islamic accounts, but replace the interest with a hidden daily administrative fee, which may still violate Sharia principles. To verify a setup is truly halal, look for an official DSN MUI stamp locally, or ensure an offshore broker has a certified international Sharia board. Aligning your trading with your values requires a deep look at a broker's fee structure, not just a label on a website. If you choose the offshore path, you'll need to maintain your own technical infrastructure to stay connected and funded. To bypass Internet Positive without the lag of a free VPN, professional traders use a private DNS like Cloudflare. It provides a stable, low-latency path directly to your broker server. For funding, many bypass bank-level scrutiny by using USDT. You buy the stablecoin on a local exchange and transfer it directly to your broker. This bridge is usually faster and cheaper than international wires, and it keeps your trading capital separate from your primary bank statements. Trading globally from Indonesia depends on building a resilient tech stack for both your data and your funds. There is a third path used by intermediate traders who want global leverage without moving their local savings offshore. Global prop firms allow you to pay a small evaluation fee. If you pass, you access funded capital, often $100,000. Because you're buying a service, not depositing capital, local 1-to-100 leverage caps don't apply. You must still report these profits on your annual tax return, typically as foreign service fees, to remain compliant with Indonesian tax laws. This model allows you to keep your personal wealth in local banks while using institutional capital for market execution. This matrix matches trader profiles to their ideal setup. The preserver, trading life savings, belongs in the BAPEPT ecosystem. The optimizer needs an offshore ECN with crypto funding, and the professional, seeking scale without personal risk, uses the prop firm model. Regardless of your path, avoid TTIP Dana money managers. They promise guaranteed returns that are mathematically impossible and are almost always fraudulent schemes. Success in the Indonesian market requires choosing the right tools for your specific strategy. Download our compliance checklist to verify your setup and start trading institutional-grade spreads with NX1.